The Matrix is a system, Christian, and that system is our enemy. But when you're inside, you look around. What do you see? Businessmen, teachers, lawyers, carpenters, real estate investors, loan officers, real estate agents, the very minds of the people we are trying to save. But until we do, these people are still a part of that system, and that makes them our enemy. You have to understand, most of these people are not ready to be unplugged, and many of them are so inured, so hopelessly dependent on the existing system that they will fight to protect it. The Matrix is everywhere. It is all around us, even now, in this very room. You are naive, Christian. Like everyone else, you were born into bondage. Like everyone else, you were born into naivete, into a prison that you cannot see, taste, or touch. A prison for your finances.
Today's episode of Mortgage Monday, Christian and I will be breaking down the financial prison that is a loan estimate. And when you are done with this episode, like Neo, you will be able to see the matrix, defeat the matrix, and avoid being taken out by the financial matrix that wants to take your money through closing costs with the bait of lower rates. All this and more in today's episode of Mortgage Monday. Christian Bachelor, what's going on? Welcome to Mortgage Monday.
Not much, dude. We got a good one in store for you, though.
We sure do. For the first time in my lifetime that I've ever seen, we are going to be showing you a real life loan estimate in the flesh, what they are, how to decipher them, and you are going to leave this episode feeling like Neo himself. So as you're listening to this, you will see that we will pull up a loan estimate and explain what is on it, what it means, and how it ties together with all the other elements to give you more power negotiating and understanding the product that you are getting.
That's right, guys. We're going to be going through a live loan estimate from one of my deals that I closed as a buyer, explaining line by line what each item means and what you need to pay attention to make sure that you're not getting the wool pulled over your eyes from some not honest loan officer in the industry. Keep tuned for this one. Make sure you watch till the very end. We got a little surprise at the end. Come down and leave comments in here so we can get in touch with you directly and make some real fun interaction out of this one.
There are three main components to a loan estimate. If you understand these three components, you'll understand all the rest of what we're going to be teaching you today and where it fits into this framework. And those are your payment, which is also known as your PITI payment, principal, interest, taxes, and insurance, the term of the loan, and then the fees that you are being charged by the lender for the right to use their money. Let's start off with what a PITI payment is.
As you alluded, PITI, P-I-T-I, stands for principal, interest, taxes, and insurance. Obviously, the principal and interest are the cost of borrowing your money. The principal is the portion that you're paying back to the lender. The interest is the cost of borrowing that money, right? The premium the lender collects to lend you that money. Your taxes are your property taxes, required for most properties in America. And your insurance is otherwise known as your homeowner's insurance. That's what protects the property in the event of fire, wind, water damage, all the things that could harm the property. And remember, your lender has an interest in your property, so they require you to have a homeowner's insurance policy to protect it.
That's right, because if your house burns down, the lender's like, well, if you don't send me a payment anymore, what am I supposed to do here? And most people aren't going to be making payments on a house that no longer exists. So they want you to have homeowner's insurance, or they require you to have it. So that's going to be your PITI payment. And the reason that it's made up of PITI is that most people choose to impound their taxes and their insurance and pay a portion of it every month with their principal and interest, which we'll be covering later in the show. Now, the next thing is the term. What does the term spell out?
Yeah, so the term is the general characteristics of your loan. Is this a 30-year fixed? Is it an adjustable rate mortgage? Is there an interest-only section? Is there a balloon payment? Right? All these different ways that mortgages in America can be structured. We will actually specify where on your loan estimate it will define the characteristics of your loan.
Thank you for that. And lastly, and this is the part people should pay the most attention to because the first two are pretty self-explanatory. What are the fees?
And the fees encompass everything. So obviously the thing that people are the most familiar with is lender fees. That's when you're shopping lenders, how to compare them essentially. But what people don't realize are the weird rules that we have to play by with third-party fees, which is all the other guys that are involved in the transaction, right? The appraisal, title, escrow, and we'll get into these one by one and make sure that if you are reviewing two loan estimates from different lenders, you're doing so on an even playing field and you're actually making the best decision for you.
Man, we are learning a lot, and the more you know, the more you grow, and knowing is half the battle. And if you want to be able to go into battle as a real estate investor and win every single time, you need to get trained, and what better place to do that than a boot camp? Christian, tell us more about the next BiggerPockets boot camp.
That's right, guys. Are you not sure how to become a successful investor in today's market? Well, you can come join hundreds of investors just like you as they pick a market, analyze deals, overcome common challenges, and get their next winning deal under contract. All the way from rookie investors to aspiring Airbnb hosts, small multifamily landlords, there's communities for everybody. Choose your boot camp. BiggerPockets.com/boot is where you need to go to find out more information.
Thank you for that. So fees are made up of two parts, lender fees and third-party fees. Let's get into the first of them. What should somebody look for in a loan estimate? So if we send you a loan estimate, this is the part that you should pay attention to compare to somebody else if that's what you're doing. First off is going to be the interest rate.
So if you're following along with me, this is on the first page of our loan estimate. Literally the second line, pretty close to the top, is your interest rate. Obviously, first line is your loan amount. So only slightly less important than your loan amount is your interest rate, right? That is what everybody wants to know about. That is what the Fed is impacting in the economic environment, right? But that is the interest rate. That's the yearly interest that you're going to pay to borrow that money.
Now, obviously, when you are the borrower, a lower rate is better. But when you are the lender, which, by the way, is different than the loan officer who you're communicating with, the lender is the source the actual money's coming from. You don't get the money from your loan officer most of the time. When you are the lender, a lower interest rate is bad. When you go to sell the loan, you get less money for the loan. So what they will typically do is in exchange for a lower rate, you are going to be paying more money to that lender. And this is made up of lender fees. So can you explain what lender fees are and what the different types of lender fees that you may be paying are accumulated of?
And once again, following along with me, guys, and fun fact, this is actually one of my mortgages that I've gotten. So these are not fake numbers. This was a loan in 2021. You can probably tell by that interest rate. On page 2 now, under the loan cost section, we have section A that is titled origination charges. That is where your lender fees are. Okay. So as you see on my line, we have a section for points. That's the points I paid on the loan. We have a section for loan origination, right, which you see I paid there. And we have an underwriting fee, which is the third type of thing that can be charged in a lender cost worksheet. Okay. Now, the reason why we brought up these two things first, the interest rate and your lender fees, is that these are the only two things when you are comparing lenders that you are comparing. It's the only two categories that you have to focus on. The biggest mistake that most first-time home buyers or maybe not as educated buyers are working on and looking at is the total cash to close calculation. They think, well, this lender has a lower cash to close. And you can see that's down on page 3, literally in the section calculating cash to close. The problem is not every lender will quote third-party fees the same. So if you're just trying to compare, like David and I said, on an even playing field, compare the rate and compare the lender fees, not the third-party fees, because those will be the same no matter which lender you use, no matter how they disclose them.
Okay, so let's sum this up. We've got points. What are points?
Points is a percentage of your loan amount that you pay, typically to acquire a certain interest rate. The lower the interest rate, the more points you pay.
There you go. So there's an inverse relationship there. And then you have origination fees. And what are those?
That is if there is an added expense that your actual loan officer is charging you, that is their income.
And then that is a way that lenders can make more money if you might be getting a lower interest rate.
Yeah, underwriting fee is basically, we call it in the industry, the keep the lights on expense for the lender. So if you're working, for instance, with us, with a broker, that's the cost. Let's say we do a loan through X lender, a Chase, a Wells Fargo, let's say. That's the fee that Chase has to pay their underwriter just to clear the file. And that's just the keep the light on fee, right? They got to pay their staff.
There you go. And then the processing fee, what's that?
Yeah, we do not charge one, but in the event a lender that you're working with does, that's the fee they collect to pay their processors, which are the people in the background collecting documents, making sure the loan files through smoothly.
Now, that's the main stuff. If you could just understand the first part of this show, that you've got 3 components that make up a loan estimate, the PITI payment, the term, and the fees, and that the fees that you typically need to look for are points, origination fees, underwriting fees, and processing fees. You've got a ton of value, and you have a very good opportunity to compare one loan estimate to another and get apples to apple. A little smaller thing to be looking at would be third-party fees. Christian, what are these?
Yeah, the most important thing to understand here is that no matter who you use for your lender, the third-party fees by the close of escrow are going to be the same. Let me give the most common example of where a loan officer can kind of manipulate their quote to look better than another. Let's say I quote you a loan estimate and I'm actually doing my job and I'm saying, hey, there's going to be some cost for like a homeowner's insurance policy, let's say. Let's say it's $3,000 a year. I'm actually estimating what I think it's going to be. I'm giving you a fair quote. Obviously it's not an actual home insurance quote, but I'm at least advising you that there is going to be a cost there. Let's say you have another loan officer that quotes you $0 for a homeowner's insurance policy. If anybody can come into the comments of any of the viewers on here and tell me the last time you bought a house with a $0 insurance policy that you didn't buy in cash, I would love to know who your insurance provider is, because that doesn't exist. But in theory, that loan officer who's quoting the other not correct quote would be $3,000 cheaper than me because he's omitting a home insurance policy. Now, if you're just looking at the bottom line total cash to close, his will be $3,000 less than mine, even if all things are the same, even if we're matched interest rates, even if we're matched payments, everything else is even. His would look artificially lower because he omitted a home insurance policy. But remember, guys, if you actually get to closing with either of these two lenders, me or the other guy, you're going to have a homeowner's insurance policy, and it's going to be the same number regardless. So, David, to answer your question, the biggest thing to notice with third-party fees is that they do not change depending on your lender.
It's basically whoever you have chosen through either the real estate contract, the agent, or the lender to perform these services, right?
Yeah, and the most common fees, to answer the second part of your question, David, we have title and escrow fees. Once again, that is typically chosen prior to you even talking to your lender because that's usually confirmed on the purchase contract.
The real estate agents usually work that out.
Correct, 100%. So we have title escrow. That's the companies that are facilitating the deal. We have an appraisal company, which appraisals are pretty standardized nowadays in terms of fees. They're anywhere from $500 to $800 usually. There is a credit report fee, okay, which is just the cost of obtaining your credit report. And then there are taxes and insurance costs. So that's the property taxes and the homeowner's insurance that are part of the cost of acquiring this property.
And that's included here because usually we think of taxes and insurance as a monthly payment that we pay. But what actually happens is you pay for the first year in full with your escrow for the property. And then to collect the next year's taxes and insurance, they collect 1/12 of that with every single payment. All right. And this moves us along to the last part of a loan estimate that someone should be looking for. And this is the good news. These are your credits. So everything that we have described so far is a debit. This is money that you are spending. But sometimes in these deals, there's money that will be credited to you. What are the two categories there, Christian?
This is definitely the happy news on loan estimate, right? This is number one. In the event you have negotiated this, you're working with a realtor that has some high quality skills and thought about getting you some seller credit. We've discussed this a lot on Mortgage Mondays, but seller credit is the seller giving you money to cover part of your closing costs. Really good gig, right? You don't have to come up with all that money out of pocket. Once again, guys, directing back to the loan estimate on calculating closing costs, there's a line that specifically says seller credits. And you can see on this example, this was my purchase, I got a $2,500 seller credit. Pretty good news. That was $2,500 less I had to bring to the table. There's also the second type of credit that is a little less common, but also very beneficial if you can work this out in your deal, is lender credit. Okay. This is where there is some sort of credit the lender is giving you based on the interest rate that you're choosing to offset your closing costs. Okay. And you guys can see here in section J on the second page, I received a lender credit. Okay. And I received a $520 lender credit, which is pretty cool. So altogether, I got about $3,000 of credit on this deal that helped me offset my other closing costs, the title, escrows, the tax, insurance, everything else that we mentioned. Make sure you confirm that any credit that you're expecting is actually on your loan estimate, because it's possible, guys, loan officers are, they're human. Sometimes they make mistakes. Even if it's on your purchase contract, if the loan officer doesn't get that and the underwriter misses it, it's possible you're leaving some money on the table there.
Now, we do have a bonus section here. We've given you the main four, but we've got extra value like we always do at BiggerPockets. And this is understanding what an impound account is, because this will also be on a loan estimate. Christian, what is an impound account? We briefly mentioned it earlier.
Yeah, David, you kind of alluded to it earlier. The easiest way to think about this, guys, is that it's a savings account. So these fees that you have every year, typically your homeowner's insurance and your property taxes, you owe those bills every year, right? Some taxes are collected twice a year, but just stay with me, right? They're both a year expense. Instead of you just paying the lender your principal and interest, you can choose to go pay your taxes and insurance yourself, but most people choose to bundle that with their whole entire mortgage, which is why we usually call a mortgage a PITI, including that T&I for taxes and insurance. And what the impound account does is that you pay, just like David said, 1/12, so 1 month's worth of your taxes and of your insurance every month, so that at the end of the year, when that balance is due, the lender dips into that savings account and they pay the bill for you. And it's really just a way to make sure these things get paid, because the lender has a vested interest in making sure your taxes and insurance are up to date. But it's also to limit, especially a lot of first-time home buyers, it could be hard coming up with a 12-month expense on no notice, right? I mean, your property taxes could be $10,000, $15,000 a year in a lot of states, right? So instead of requiring a borrower to go through the financial stress of doing that, they would rather collect $600-700 a month on your mortgage and ensure that you have enough by the end of the year to pay the entire amount.
Great point. Now, we typically take a lot of these costs and fees and then lump them up all together and call them closing costs, right? But those are actually made up of a lot of different things. And those closing costs are spelled out on a loan estimate, which is actually something the government requires if you're going to be using a conventional loan. There is laws that force the lenders to declare to you, hey, this is what we are going to be charging and this is what you're going to be paying. And by the way, this is all the other people involved and what you're going to be having to pay for them. And this is cool because sometimes when you sell a property, you forget that you had money in an impound account and then you sell the property and the title company pays off all of the loan that was due and you get the rest of the money wired to you. And then when the impound account shut down, they then send you another check for all this money that you forget having come. That's happened to me many times. And it's that, reach your hand into your coat pocket and pull out $15,000 that you had in an impound account.
Fun fact, guys, I got one sitting on my desk right here from property I sold. This is my impound account balance, right? I got to go obviously run to the bank and deposit that. But just like David said, I had money remaining that had yet to pay my taxes and insurance. That comes back to me. That's a savings account. That's my money and it wasn't used. Right. So that is owed back to me once you close out the loan.
Anything else, Christian, that you want to add?
No, I think it's been super great. What would be really cool, guys, all of you guys watching this video, jump into the comments here and comment maybe something that you saw in your loan estimate that you didn't understand. I'll specifically come back to this video once it airs and I'll answer your comments in the thread there. So get in there, get involved, let us know how we can help. And obviously, if you need to reach out to us, you can find me, Instagram at The One Broker, our website, theonebrokerage.com. David, where can we find you?
You can find me very easily at davidgreen24.com or any of your social medias at davidgreen24. Send me a DM and let me know what you thought about today's show. And let us know on YouTube, did you like this show? Are you glad finally somebody explained to you how to read a loan estimate? Are you happy that BiggerPockets exists and it's given you all this information for free? Let us know if you liked it and then please like the video and share it with somebody else who may also be intimidated by the lending process and doesn't want to necessarily admit that. This is David Green and Christian Bachelor of The One Brokerage for BiggerPockets, signing off.